Welcome, everyone. My name is Frank van Willert, and I would like to welcome you on behalf of the Travel Logistics and Infrastructure Practice to our webinar today about the post-pandemic airline sector. And first of all, let me introduce our panelists. We have Jaap Bauer, a senior airline expert from our Amsterdam office. We've got Vic Krishnan, who got up very early, our airline sector leader in the Americas. We've got Steve Saxon, who's staying up late, our airline sector leader based in our Shenzhen office. And we've got Nina Wittkamp, one of our airline sector leaders in Europe, based in our Munich office. And they'll guide you through this discussion today. We have disabled the chat function, but you have the option to use the Q&A functionality of the webinar to register your questions at any time. Feel free to do so. I'll act as the moderator and collect the questions and then pass them on to the panelists at the end of the session to answer as much as we can. And I'll apologize ahead of time. We'll likely not be able to get to all of the questions, but we'll do our best to address the most interesting ones and see if we can follow up another way later on. With that, and without much further ado, let me hand it over to Jaap, who will get us started.
Thank you, Frank, and welcome from Amsterdam also from my side. Thank you all for joining us today for this webinar. I will take the next few minutes to talk a bit about recent traffic patterns and our outlook before handing over to Vic to introduce some of the shifts that we expect to see in the post-pandemic airline sector. So where are we now in terms of recent traffic volumes? Well, traffic overall still materially is very much down. This chart shows monthly O&D passengers by region indexed to 2019. There at the bottom end of the spectrum, you see Europe. There's a larger share of international traffic in that region, meaning that travel restrictions apply. Case counts in some parts of Europe still quite high, leading to very much depressed air traffic volumes at the moment. On the other end of the spectrum, you see North America and Asia. But it's important to note that also within regions, there are large differences in how traffic currently looks. So take Asia as an example. China domestic within Asia, that is running at roughly 90%, a bit over 90% of 2019 levels at the moment. Markets like New Zealand, domestic, also low case counts. Traffic there at the end of March, roughly 70%, a bit higher than that. Versus 2019, but that compares very starkly to some of the Southeast Asian markets or India for that matter, where case counts have unfortunately been very high recently. Making projections in these circumstances is always hard. We tend to think for our macro projections in terms of two major axes. The first axis, and that is here, the x-axis of the chart, is the economic policy axis. That is referring to how much of a recession is there, how deep is it, how long is it, how effective is economic stimulus of individual countries. The y-axis is the virus health or the virus impact and public health response, sort of how effective are countries at containing the virus. If you combine these two axes, that leads to 9 different scenarios. And we regularly poll global executives about the likelihood that they think each scenario has. Over the last few times that we did that, A1, sort of the one right in the middle of both axes that is highlighted on this chart, came out as the scenario that most people at this point in time think is most likely. We then sort of turn those scenarios into air traffic projections. And we model that based off when we see travel restrictions being eased and lifted. We combine that with the economic outlook scenarios by country developed by the McKinsey Global Institute. And we bolt on top of that any structural or short-term changes in travel behavior. Do we see any changes in the amount of trips that people take? that is done sort of at a flow and country specific level. And on this chart, you see the high level outcome of that for each of the scenarios. And each column is the global RPKs, sort of airline demand indicator by year. So if we focus on A1, the scenario right in the middle of the screen that came out as most likely on the previous chart, that would see a return on the global level, return to 2019 levels of demand by 2024. Next year already, though, that scenario would reach roughly 90% of what traffic level was in 2019. There's more pessimistic ones that you see on this chart, but also more optimistic one. The more optimistic one, A3, would see a return to 2019 levels already next year. We've been doing these projections for a few times now since the start of the pandemic, and we compare them as well. On this chart, you see the high-level projection result for the A1 scenario of the current scenario, and we compare that to some of the previous iterations of this work. Overall, you see that comparing the most recent to earlier versions of the projection, volumes for 21 come out a bit lower. Sort of there's a bit more pessimism around this year, which has to do, compared to the start of the pandemic, with the new variants emerging, for example, the more infectious variants. On the other hand, sort of 21 looks a bit lower than originally projected, but 22 looks a bit higher, sort of lower volume this year, but more of a rebound next year. Vaccinations are a key, of course, to get out of this, and vaccination campaigns are in different states of progression around the world. Our healthcare colleagues identify 7 factors that are likely to influence the timing of herd immunity by country and region. You see them on this chart for a selection of countries and regions. These factors, they include, of course, how much of the population has been vaccinated so far, but it also includes things like how many vaccines have been secured, how ready is the supply chain to distribute these in a timely and effective manner. What's the consumer sentiment? Are people sort of eager and willing to take vaccines, or are they a bit more hesitant? And it looks also at natural immunity levels and the existence of different variants of the virus in the country. We score these then on whether or not that's favorable to herd immunity or less favorable. And from this chart, you see already that it's a whole mosaic of different colors, which then means that when individual countries reach herd immunity, will likely be quite different. We do see a direct effect linking it back to air traffic with volumes of passengers. This chart shows daily passenger throughput at US airports and indexes that to 2019. The white line is the line for this year indexed to 2019. And what you see sort of on the left of the chart, for the early months of this year, vaccination levels in the US were roughly 10%. The line stayed mostly a bit flattish. After that, vaccination speed sort of picked up. It's now more than 45, close to 50%. And you see sort of the upward trend in terms of traveler throughput. A lot of that is domestic, obviously, sort of international is lower. But there's an immediate sort of positive effect as soon as there's somewhat of a return to normalcy. And as an aside, the figure on the single day last Sunday was 90% of what it was in 2019. After that, it dipped, but the overall trend is upward, as you see on this page. You also see this when you compare forward booking levels of countries with higher vaccination rates, and you compare those to countries which are a bit lower levels of vaccination rates. This data comes from IATA's Travel Pulse. It's a dashboard of leading demand indicators that's available to all airlines, developed in cooperation with McKinsey. And on the left of this chart, you see two examples of countries with higher vaccination rates, Israel and the US, and the level of forward bookings, where you see a bump up in the coming months around volumes. You don't see that in countries with lower vaccination rates, like France and Brazil on this slide. So there appears to be a direct effect as soon as there's somewhat of a return to normalcy. That sort of pent-up demand is visible every time travel restrictions are lifted. This chart shows passenger forward bookings on the UAE to UK flow. End of last year, at some point, quarantine rules were lifted, leading to an immediate upwards surge in travel bookings, sort of the blue line that you see on this chart. That dissipated again once restrictions were reimposed after new variants materialized. But it's clear every time that travel restrictions are lifted, especially VFR and leisure travel is showing signs of a lot of pent-up demand. That is, for example, also visible, was visible over Easter when Germany eased restrictions on travel to the Balearic Islands, but there's other examples as well. So lots of pent-up demand, especially on the VFR and leisure side. With that, let me hand over to my colleague Vic to introduce some of the shifts that we observe in the airline sector.
Great, thank you, Jaap. You go to the next page, please. Yeah, thank you. We expect 5 themes to take hold as the airline sector recovers from this crisis. The first is that leisure travel will lead the way. The second is that airline debt levels will require higher ticket pricing for sector economics to work and for balance sheets to close. The third is that the performance of relative winners and losers in the sector is likely to diverge even more than it did pre-crisis. The fourth, aircraft supply is likely to be abundant with the surfeit of parked and retired airplanes, which might lead to aircraft markets being oversupplied for quite some time to come. And then the fifth is that air freight and e-commerce might be very buoyant for a while. Many of us have gotten used to using digital tools to make purchases that we might have historically done in person before, and that is leading to an unprecedented boom in air cargo, which might stick around for a while, even once this crisis is behind us. Next page, please. We're going to do a bit of a double click on the first theme, and once we go theme by theme, we're going to close out with a call to action. On the very first theme around leisure travel, we see a lot of focus among airline sector observers regarding when air travel demand is likely to return to 2019 levels. The reality is that it varies significantly by type of travel. So if you look at domestic leisure travel, that's expected to bounce back very quickly. And in fact, in many countries, it has already bounced back to pre-crisis levels. Corporate travel, however, is the laggard. We've all learned new ways of doing business virtually. Companies are managing their travel and expense budgets down. And while business travel in some markets like China is already back to pre-crisis levels, we don't expect a rapid rebound like that in the rest of the world. And therefore, when you put it all together, the airline sector isn't necessarily likely to fully recover to 2019 levels until the 2023 or 2024 time period. And while that varies significantly depending on which part of the world you're in, the view that leisure and VFR, or visiting friends and relatives travel, will recover faster with business travel lagging is something that has been somewhat even reluctantly accepted even by airline industry executives. Next page. All of this is quite consistent with patterns that we've seen during prior crises. So the data you see on this page is from the UK. It dates back to the September 11th and the 2008-2009 global financial crisis. And it shows that while the primal instinct to associate with friends and family remains resilient throughout most crises, we saw that in around September 11th, we saw that around 2008 and 2009. And VFR travel now is several orders of multiples higher than it was in the year 2000. Business travel is very, very slow to recover. And if we look at business travel post the global financial crisis in 2008, you'll see that business travel 13 to 14 years later has still not recovered to 2007 levels quite yet, which is quite shocking. And so therefore, the impairment to business travel might actually be quite profound. While it's still early a number of US markets already are or will be ahead of 2019 levels by the summer. So Jaap earlier showed you some data for US TSA, which is the Transportation and Security Administration passenger counts, i.e. the number of people going through US airport security checkpoints. We're seeing common days for leisure travel during the week. So think Friday through the weekend, seeing a lot more throughput at TSA checkpoints than midweek business days, which suggests that quote unquote leisure days are recovering a lot faster than business travel days. Though during this crisis and with the bleisure trend of being able to actually work from leisure destinations, we're seeing a bit more of a blurring of the lines between business and leisure travel to begin with. Next page. Yep. For each shift, we have a call to action. For the first one, which is around the leisure travel trend, we think airlines should think again about whether to deploy small or large aircraft. The industry moved very quickly towards smaller airplanes, what we call downgauging, during this crisis based on the relatively accurate belief that business travelers value frequency and therefore their bias is going to be towards smaller rather than larger airplanes. However, with the slower recovery of business traffic, this may be hard to do. And we see many airlines that have been retiring their largest aircraft in their fleets during this crisis. We're not sure whether the focus on smaller aircraft really is the right choice. It might be better to fly an infrequent larger aircraft with lower unit costs because the per trip costs of a larger airplane often tend to be lower than on a smaller airplane. And it may be more advantageous to fly an infrequent larger aircraft with lower unit costs than a smaller high frequency aircraft. While this is clearly going to vary for every airline and varies quite a lot from one route to another, the per trip cost is pretty important to analyze. With more leisure travel, schedule is less important, and there might be benefits to scale. And with that, I'll hand this over to my colleagues to take us through some of the next few trends.
Thank you, Vic. I'll take over from here with a second call. Now let's look at the financial implications. So where do we end up in the end of 2024 from a debt standpoint? So in line with our recovery forecast, we've looked at a timeline until 2024 and have projected what would be needed over the next couple of years in terms of financing. This is a reflection of a worse 2021, as Jaap said at the beginning, and probably a much more cash-consuming 2022 in light of the restart. We need to bring pilots back. We need to catch them up on training events. We've deferred maintenance events. And at the same time, the industry did reduce cash burn significantly from $50 billion in 2020 in the second quarter to half of it, about $25 billion in the first quarter of this year. Of course, that's partly due to lower repayments, but also stricter cost control. And if you're adding that up to normal CapEx, we will actually end up between 870 and 1.1 trillion US dollars in terms of debt levels. That results in a significant increase for net debt to revenue ratios. And that also means that for the next couple of years, the financial resources are needed to repay debt instead of investing into long-term improvements, investing to becoming better. So at an industry level, if you go to the next page, that puts the airline industry in a very challenging and maybe also somewhat uncomfortable position. You see the degree of leverage on the left-hand side, so that's the net to debt revenue ratio. And the x-axis looks at the instability of earnings in this case. You see a lot of industries levered at much higher rates, but also with much higher levels of stable earnings. And the airlines, even in 2019, which generally is considered a good year for the industry, was in a unique position and actually now moving up higher on the top right-hand side of this chart, which is, of course, not a very good position to be in. And what does that mean in terms of implications? If we go to the next slide, please. A couple of consequences we wanted to run through. So first of all, the credit rating. So the median credit ratings could decrease or plunge by 5 notches. And that adds over 10 billion in terms of annual finance cost. an increase in credit card holdbacks required, and actually an acceleration of that vicious cycle we talked about a bit earlier. So that level of debt is fundamentally unhealthy and also quite expensive. To put this into a perspective here, even considering the pre-COVID levels of free cash flows, and again, 2019 was a good year, it could take until 2030 or even later to return to 2019 leverage levels. But actually only if we continue the cash discipline and the discipline on CapEx and investments that we're currently seeing. And that actually means fewer fleet upgrades, but also fewer upgrades of IT systems and a lot of initiatives around performance improvements that the industry was looking at and already doing that require big investments in IT and systems. And a lot of that will have to be on hold for the next couple of years. So in order to come through the recovery with a much smaller increase in debt over the next couple of years, the industry has to fundamentally improve its cost basis. And if nothing done, that will obviously increasingly limit the investment ability for almost the next decade. And that was obviously exactly what many of the airlines were looking at and were needed. So I also want to spend a few minutes on the broader environment in the industry and how that could change over time if we move to the next page, please. I think from the experience, what we've been seeing at the beginning of the COVID crisis, there could very well be a development towards clearer regulation and requirements for cash on hand. In the past, a lot of airline executives were quite comfortable with having cash equivalents of 20-25% of revenue at hand. Obviously, at the beginning of the COVID crisis, with the waves of cancellations and refunds starting, that has shown us that a lot of that revenue was unflown revenue and was actually not belonging to the airlines. So we could imagine mechanisms that look like the stress tests that you see in the banking sector, where you need to take into account the part of the cash at hand that may be required in order to cover for refunds. Then second, also, we've previously done work on the profitability across the value chain, and that has consistently shown that airlines destroyed value across the board, obviously, or at an industry aggregate level, where other parts of the value chain did much better. And so there's a real question about how we can set boundary questions for the aviation sector, to become a much more sort of balanced ecosystem from a financial health perspective. And then also, many countries have historically put strict ownership caps on airlines, which, at least from a finance perspective, has limited the ability for airlines to recapitalize. There are certainly places and opportunities to loosen ownership caps to let capital free flow, or allow free flow of capital and reduce the need for example, government bailouts going forward. So if we take that back to airline industry, financial health and performance, if we move to the next page, please. Already pre-COVID, we saw large performance differences between these airlines. The value chain study I mentioned earlier has shown that just about 30 airlines are actually earning their cost of capital over a longer time period. What we're seeing at the moment is that many airlines are breaking glass on the cost side and are revisiting every line item in the P&L. And that's not only done to reduce daily cash burn on a more shorter term basis, but also to fundamentally change the long-term cost position and the unit cost that the airlines are operating at. And we expect that will create a greater divide between the ones that went through a transformation and have fundamentally tackled their cost position, and the ones that did not. So actually now is a really good time to define what kind of cost position and cost level is needed as we're coming out of the COVID crisis. So what does that mean going forward? If we move to the next page, please. It's never wasting a good crisis is a very well-used phrase, but it actually applies in this case. And I would say, even though the ability for investments might be limited, given everything we just talked about, there are a number of initiatives to consider to come out stronger and better, not necessarily bigger. So I'm just going to pick up on a couple of these themes since some of them are probably self-explanatory. But overall, I think this is a lot about decreasing fixed costs and achieving greater flexibility, given that labor is among the biggest cost buckets. That is a place to start. We've seen a huge increase in the need for data, and data needs are moving up the funnel. So more data used in network planning, in scheduling, and one of the areas where we've seen the strongest effect is on pricing revenue management, where the industry neither had a baseline for demand or of demand, nor did it have the pricing, nor did the pricing algorithms really work in this case. So we saw a lot of airlines turning to things like early demand indicators and alternative data set, but that obviously also requires the ability and capacity to aggregate, consume all that data and make use of that. And last but not least, the industry has been talking about the distribution shift and the notion of retailing concepts for quite some time. We're seeing that the pandemic has pushed a lot of consumers to online and to digital channels. We surveyed European consumers, and 60% of them at least expect to continue or move towards digital shopping for travel. And travel is actually the highest growth category across all shopping categories. So we expect that to be a trend that is staying. So I'll hand it over to my colleagues for further calls for action.
Thank you, Nina. So I'll pick up the fourth shift, which is what's happened and happening to one of the key cost components, which is the price of aircraft. What this chart shows is what's happened to the lease rates. And the lease rates for both wide bodies, an example on the left, narrow bodies, an example on the right, have come down significantly from where they were pre-crisis. And this is because of the oversupply. Many airlines have off-hired aircraft, or they've postponed taking delivery, and therefore there is oversupply in both the wide body and the narrow body sectors, and that has reflected through on the lease pricing. Note, though, that this is only the prices you can get for a new lease. So airlines who are in the position to be able to take out new leases at the moment are benefiting from 30 to 40% lower costs on one of the key cost categories than their peers. There's also another group of airlines who have been able to get access to this, and that's those who've had some form of court-sponsored restructurings. So if you have Chapter 11 or an equivalent sort of restructuring, those airlines have been able to significantly reduce one of their major cost categories. Airlines who haven't had that ability, maybe they've got a few payment holidays and there's some minor concessions from the lessors, but pretty much otherwise lessors are forcing and enforcing contracts. And that actually pushes slightly against one of the things Nina talked about earlier, which is that actually the stronger airlines have not been able to renegotiate the leases as much as some of the weaker airlines have had access to bankruptcy measures. Looking forward, I think we see continued oversupply on the wide body sector. The narrow bodies are more likely to come back quicker, and that's driven by where the rebound is. The rebound will be earlier on domestic and will be earlier on short haul than it will on some of the longer intercontinental flows. So what's the call to action from this? Really, this is an opportunity for those with the ability to be stronger. Nina talks about the crisis gives the opportunity for airlines who went into it stronger to emerge stronger. Those with less debt, higher profitability are able to act countercyclically. And it's obviously one of the most difficult things to do is say, okay, look, we're not flying our current fleet. Why would we lock in additional aircraft? But we are working with clients and seeing airlines lock in now additional capacity, expecting the boom to come. And by locking in now, you're getting lease rates considerably lower and therefore bringing down the cost base versus other airlines who are not able to make those counter-cyclical decisions. It's made easier by some of the deals available from some of the leasing companies. Many will offer deferred payments or power by the hour arrangements for the first few years, which reduces the risk of taking that. Moving on to the fifth and the final shift we see, it's around cargo. And 2020 truly was an extraordinary year for air cargo. Whether that was good or bad depends if you were a cargo airline or a shipper. But certainly we've seen prices spike. The average prices went up by 30%, but on certain trades at certain times of the year, we were seeing prices up to 4 times what they'd been historically for air cargo. And the reason for this is the mismatch of supply and demand. Historically, 50% of air cargo was carried in the bellies of passenger planes. If the intercontinental passenger planes are not flying, that capacity disappears. Those with freighters flew them more, of course, and they flew and continue to fly them as much as they can. But overall, that led to capacity being 30% down versus 2019 levels. That led to a crunch, and demand actually was very healthy because there was air cargo demand always goes up at times of crisis because people need to move things urgently. There was need for moving medical equipment, personal protective equipment, vaccines, and so on. So there's a healthy demand, but a capacity crunch. And that's what led to the pricing spike. The planes are fuller than ever. And for those sitting on freighter fleets, like the EBIT margins are 60 times what they were. Now, that's from a very low base because the air cargo has been an industry which has struggled over the last 10 years. And they're going through a super cycle. The intermediaries in the market, the logistics companies, the forwarders are doing okay. They suffer a bit from the lower volume, but mostly that's a pass-through business. So the shippers are struggling to get capacity and paying significantly more, which is great news for airlines with freighters. Now, what's this look like going forward? So we've modeled some scenarios on the next chart, please. We've modeled some scenarios looking at what we would see as natural demand. And how that's likely to recover, which is the blue bar on the left-hand side of each of these periods. And then we look at what we think is the likely supply. The lighter supply is the freighter supply in terms of ton kilometers. And then we put on what we see as the belly supply coming back from the different scenarios which Jaap took you through earlier. And first of all, we then look at 2 of the different scenarios. I think if we believe that actually the demand is coming back quicker and passenger aircraft intercontinentally are going to be back, maybe the undercapacity lasts through until about the end of this year and then it starts to equalize. But increasingly, especially on the intercontinental routes to and from Asia, which is crucial for air cargo, we're seeing a slower recovery as more likely. And so our view is more towards the second of these 2 scenarios. And in this case, that means that we actually don't see the supply getting up to the levels to cater with the demand until 2024. Air cargo pricing is likely to come down from the super peaks, but it's likely to remain healthy for many years, therefore, especially out of the key Asian hubs. The question, what do you do about this? So our call to action is to really think, for every airline to think carefully around its stance on air cargo. The trend over the last few years was to exit cargo. Many airlines, European, US carriers, exited the full freighter business. It wasn't profitable, and it's been left to a few more specialist airlines to fly full freighters. However, there are opportunities for airlines. There's a short-term opportunity of using passenger planes to fly cargo only, what gets called freighters. And if you joined some of our previous webinars, we've shown some break-even analyses, like with good air cargo levels, roughly 50% higher than what they were in 2019, it can make sense to do that. It can make sense to fly passenger planes with cargo only. But clearly, it's not a long-term replacement for the freighters, and kind of as soon as pricing comes back down, that becomes uneconomic again. So the question then is, should airlines be looking at reinvesting into a freighter fleet? And I think if you believe, especially to and from Asia, that yields remain high out till 2024, there's a good argument for doing that. Obviously, freighters are hard to come by on the leasing market in the short term because of the spike in demand, but there are a number of conversion programs coming up. And so we're working with airlines to think through, well, does it make sense to convert some of my A330 or 777 aircraft into freighters? The economics looks good. The challenge is often the delivery, the conversion slots being available. I think our call here is like really looking, does it make sense for your airline to be bringing back freighters carefully? Thank you. With that, I'll hand back to Frank to close, and we can then take some Q&A.
Thank you, Steve, and thanks everyone for walking us through these 5 calls to action. A quick reminder to everyone, if you want to submit more questions, please use the Q&A function, and we'll pass them on to the panelists to address. And we already have a few here. Let me maybe get into one that expands the topic by one step further into airports. And Vic, I think maybe you can offer your views on what are the developments in airport debt levels, and how does that impact their ability to invest compared to the airlines?
Yeah, Frank, I think the answer there varies quite significantly by geography, right? So I'll start with my home market, which is the US and North America broadly, I should say, where many airports are really quasi-government agencies, right? They're arms of either a local government or a municipality or a city, and their leaders are often city-appointed, commissioners, and therefore their debt levels are tied to local government or municipality debt levels. And the reality is that they've got through this crisis reasonably well. The US government has actually set aside a fair amount of money for airports during the recent crisis. And airports continue with their capital programs relatively unabated. They've had to adjust the composition of the capital programs because, I mean, for some of the trends that we've been discussing earlier about leisure travel and being more prominent, you may end up needing, fewer stores that sell you suitcases and laptop bags and more concessions, because leisure travelers often tend to dwell at airports or spend more time there than business travelers do. And so there might be a change in the mix and the composition of how they should allocate their capital programs or change their master plans. But for the most part, we haven't seen as much of an impact on airport debt levels specifically. When you do go to Europe, where a lot of airports are actually either privately owned or privately operated, the answer is different, and debt levels have gone up. In some instances, there's been less support for the airport sector from national governments. And as a consequence, airports are likely to be stymied or constrained in terms of how many investments or what investments they can make in these circumstances. And then when you get into the rest of the world, in the Asia-Pacific region and the Middle East, again, the role of governments varies quite widely. And so we might see a world where a lot of Middle Eastern airports continue with their capital programs unabated, considering the fact that they too are either government-owned or have a relationship with local governments. But then in markets where private entities are being compelled to allocate significant amounts of capital to new airport programs, you might see a lot more restraint than you do in let's say, the Middle East or in North America.
All right, thanks, Vic. The next question here, I think, Steve, would be for you. Do you think the recovery will affect LCCs differently to full-service airlines?
Thank you. I think first, we find the labels a little extreme these days of low cost and full service. We've seen a lot of conversions between the models. Many low-cost carriers now have a business class, connect traffic, have a loyalty program. Many full-service carriers, or what were full-service carriers, have unbundled and will charge you for a sandwich in economy class. And so I think we've seen much more convergence of models. So we don't think too much in kind of low cost versus full service. But I think what is absolutely true is that airlines who are more exposed to leisure travel and better positioned to cater to leisure travel will come out of the crisis earlier than those who are heavily reliant on long-haul corporate intercontinental flows. As Vic talked about earlier in our projections, we see strong evidence that visiting friends and relative traffic and leisure travel is going to come back quicker. During the crisis, most of the traveling population has not lost their jobs. They've continued to earn. They've not had the same opportunities to spend it. savings rates has gone up, and every survey, including the ones McKinsey does on consumer sentiment, says the number one thing people want to get out and spend their money on is restaurants, and number two is travel. So we do see extensive latent leisure demand rushing back. Corporate travel is going to be slower to return, and especially the front end business class intercontinental long haul travel. So airlines whose business model relied on a few people up front paying you $5,000 plus for a one-way ticket, they're going to struggle much more than those who had a more balanced revenue base and were profitable from the leisure cabins.
All right, thanks, Steve. Let me pick up on that and ask the panel what the industry could do to encourage business travelers to come back, given that they're so important for a number of the players in the industry.
Yeah, Frank, why don't I start? And then I'm sure Jaap and Nina and Steve will be full of ideas. The reality is that the answer varies dramatically by what type of business traveler. And we, the airlines that we see taking a much more nuanced view to the type of business traveler are leading the way through this crisis, right? And as an example, if your customer is in the oil and gas or the manufacturing sector, they are likely to come back to travel a lot sooner, and frankly, may have been traveling through this crisis. If you're in oil and gas and you've got an oil well in Equatorial Guinea, chances are you've been going there and finding ways and quarantining and finding ways to make this work, because it's hard to shut oil wells on and off. On the other hand, if you're in professional services, like a lot of my colleagues on this call, we've all found ways to be a lot more effective and in many ways even more productive working remotely than we do visiting clients. Even that is within reason, right? So many of us are itching to get back on the road again, and frankly, doing business in person, especially when we're serving new clients, can be quite an effective way of interacting with the folks who work with us. And so, long way of saying, there isn't a one-size-fits-all answer to this. Understanding the digital adoption and the comfort and familiarity of each of the sectors that are in your customer mix, and their ability to work remotely versus not is really important. And therefore, keeping a finger to the pulse of what the recovery patterns might be by sector, by company, and by mode, i.e., short haul versus long haul, is quite important.
If I may just add, there's probably not that much you can do to re-stimulate business travel. We think it is going to be structurally down. So I think the question, let me turn the question around slightly, is how do you fill those business class seats which previously were going to be filled by corporate travelers? The long-term answer is probably actually you should have fewer business class seats, but that's clearly not a short-term easy fix. And so you look at what is the next best source of yield. And there's actually been a very strong trend over the last 10 years of premium leisure. Like you look around business cabins, and yes, there are consultants on laptops, but there are many people, there are many retirees, more affluent couples choosing to decide, look, I'll spend that bit of extra money on business class. They're not paying quite the same fares as the corporates, but compared to the seat going empty, it's still a better choice. And so I think we'll see airlines innovating much more around the premium leisure propositions to fill those seats.
And do we have any idea of what the permanent loss in business class demand of all these, based on all these online meetings, might be?
Well, I mean, at this point, actually, it's anybody's guess. And, lots of people who spend lots of time around this sector have answers that range anywhere from 5%, which is some wishful thinking on the parts of airline executives, through to 50%, which is wishful thinking on part of Bill Gates, who has an interest in Microsoft Teams being sort of widely adopted and be the technology of choice for business meetings going forward. And that's about essentially too wide a range for any investor or any expert to underwrite any kind of investment case. But the reality is that it is going to vary quite a bit, and we're going to see a lot of behavior that is going to be a bit Me Too, right? So one of the biggest drivers of what might impair business travel more permanently is if your competitor doesn't travel, as opposed to a one-size-fits-all answer for the whole sector. Our default answer in our modeling for now is that 80% of business travel will come back, But as I said, that is still a matter of a lot of conjecture.
All right, thank you. Nina, here's a question about the current state where global traffic for network carriers is often based on bilateral agreements based on revenue sharing agreements. Do you see any trend that may be turning towards sharing both revenue and costs as part of these code share agreements?
Yeah, and let me maybe start more broadly from the type of partnerships that we're seeing out there. I think, already before the crisis, we've seen an increase in joint venture partnerships with much closer collaboration, both on the network, the revenue side, but actually in some cases also on the cost side. However, I think it's also quite clear that collaborating also on the cost side or the profit side ultimately requires a very different level of commitment and collaboration and partnership. And I think to me, that's a much different way of collaborating versus a co-share agreement. So I think, these are fundamentally two different things. But I think the general expectation is right that we will see increasing levels of collaboration and partnerships and increasing number of joint ventures. And I think given everything we just discussed, there could also be more collaboration on the profit and the cost side. But I think, just have to be clear that these are very different levels of commitment and collaboration.
Thanks, Nina. We've also got a question here around whether the current trend will lead to more consolidation in the industry. And I think, you might have a thought about that.
Yeah, thanks, Frank. Let me try to start and the others can add to that. I mean, consolidation has been a much longer running trend in the airline sector with various degrees of success in different parts of the world. The industry overall remains quite fragmented, so we expect sort of that trend to certainly continue over the next few years. Whether or not that immediately happens now, of course, is a harder part. Right now, lots of airlines are engulfed still in crisis mode, in restructuring. The values of other airlines are low, but there's also not so much cash and certainly not a lot of management attention for a large integration at the moment. So right now that might be difficult, but over the longer run we expect that trend to sort of pick up again, but maybe not in the immediate near future, given that there are so many other things to solve as an airline executive. Of course, keep in mind here that it's not only full M&A in consolidation. Nina just spoke about that as well. But these JV partnerships by flow and other sort of forms that can actually mirror quite a lot of the benefits that you get through a full merger are certainly something that a lot of airlines at the moment are also thinking about. So it might also take that form.
Any other comments on this? There may be a follow-up question to you, Jaap. Sort of as the mix of leisure and business changes, and maybe some of it permanently, as we already discussed, do you see sort of de-peaking schedules as a way for airlines to lower their costs? And could we see sort of fundamentally changed airline schedules in the future compared to what we saw 2019 and earlier?
Yeah, it's a great question. I mean, the peaking seen at hub airports, of course, is driven very much by the hub and spoke model, with several peaks of ingoing flights during parts of the day, followed by peaks of outgoing flights to maximize connectivity. We recently published a research piece also on the future of the hub and spoke model in light of the COVID pandemic, where we said that, yes, I mean, some hubs will struggle, especially those with smaller home markets, but overall, the benefits to airlines operating the system in terms of efficiencies and also to passengers are not fundamentally changing. So given that the hub and spoke model is the driver behind many of these peaks, I think that will return as sort of the hub and spoke systems are rebuilt again. Of course, in the short term, there's more opportunistic flying, if you will, with airlines actually being quite agile and flexible in terms of grabbing opportunities that open up, where you might see more off-peak flying.
Thanks, Jaap. We also got a group of questions around the topic of sustainability. So let me maybe put them all together and then pose them to the panel. And maybe, Nina, you can get us started. There's one around what is the debt level and the cash crunch due to sort of the need to invest into decarbonization of the airline industry? And is that going to hurt the prospects of actually achieving major progress towards net zero 2050? And maybe a cousin of that, will the governments that are pumping money into the airlines in some of the countries, will they actually demand more progress, given that they commit to progress and they are now investing money into the airline industry? And what do we see the whole discussion around Flugscham and sort of public pressure around the waste of carbon and maybe flying play into this at all? So big theme around sustainability. What's next there in the sector?
Certainly, that's a big topic. So let me start with a couple of avenues, and then others please also jump in. So I think, starting with a government support perspective, I think we're seeing lots of different initiatives coming up. So if you take the example of France, that have clearly, tied support of the aviation sector towards moving out of very short haul flying and towards, newer, more modern and less, CO2 emissions for aircraft and the fleet deployed. So that's one. I think we'll also see more modal shift to rail and collaboration across modes in these countries. And then there are a number of countries, including Germany, where I live, that have set very clear targets for CO2 emissions actually in our constitution. And that is translated, and it's just been decided this year, into very ambitious targets for the transportation sector that will have to get translated at the end of the day. We're also seeing a lot of investments in syn-fuel facilities and a lot more, not just research, but actually active application across fleets and really tests. I think the one area where at least I'm personally still a bit less sure about is the willingness to pay for compensation for CO2 emissions versus if that's something that you fundamentally believe in, taking a different mode of transport. I think that's still a little bit too early to see how that plays out, but I'm curious what others have.
Yeah, there's two factors pushing in other opposite directions. Government demands increase as governments take increasing stakes in airlines. They have more control and are therefore pushing the big airlines harder for decarbonisation. But equally, the airlines' ability to invest has gone down. Their first priority is going to be paying back the debt and getting back to a sustainable business. But clearly the customers are demanding this. There's a segment already who won't fly, and there's a much broader segment who say they want to see their airlines making good progress. So our view is every airline needs to have a plan around sustainable aviation fuels for the short term and shifting to hydrogen-based fuels for the longer term.
One more question here on what I guess, will there be a slots bloodbath once enough traffic comes back that some of the moratorium put on airlines losing slots expires? So is there going to be some alpha dynamic evolving, I guess, is the question behind that.
Yeah, maybe I'll start. Nina, please pile on, or Jaap, both of you live in slot managed environments a lot more than we do here in the US. But the reality is that through this crisis, we've actually seen more availability of slots. We've seen airlines being able to expand service into airports where historically they were unable to operate. We've seen JetBlue make announcements about flying to the London area airports in the UK. We've seen Southwest expand into a number of airports, main airports, if you will, in cities that they didn't operate in the past. So if anything, this crisis has led to more slot availability for airlines to expand into quote unquote primary hub airports. And once you're there, it's relatively hard to be dislodged. And so, the reality is that you're probably going to see a slightly different competitive mix post-crisis at airports, and especially in slot-controlled airports, than you did prior to this crisis.
And I think just adding on to that, tying it back to the de-peaking discussion we just had earlier, I think some of that will also have an effect and ease capacity if we're in slots, during peak time. At the same time, there might be a counter effect where you have, we talked about many more smaller aircraft. So if you believe that demand's coming back, you would, ultimately need more aircraft, and that results into more takeoffs and landings and potentially more slots going forward. But that might be balanced with that de-peaking effect. And then, we just talked about sustainability. Maybe there's even incentives around giving slots considering sustainability targets.
All right. One other question we got here around what does this all mean for the future of aircraft like the A380, given the current situation? Steve, I think you've got a perspective on this.
Yeah, obviously the A380 is a challenging aircraft to make work economically. A number of airlines were struggling to make it work as part of their networks even pre-COVID. I think COVID has just highlighted the challenge of the aircraft. The sheer amount of capacity it brings in large lumps into connecting hubs is hard to manage, and certainly the Asian carriers we work with, a number of them had ordered them. Often for the prestige of flying the biggest flagship aircraft rather than necessarily because it was the right thing for their networks. And through this crisis, therefore, those airlines are looking again and are shrinking or retiring their A380 fleets. It doesn't mean that we don't think there's a role for the aircraft. Like, as Vic talked about earlier, we actually see benefits of larger aircraft on many routes. With the growth of leisure travel over business travel, the unit costs becomes relatively important versus frequency, for example. So instead of flying two small wide-body aircraft, what about one frequency on a larger wide-body aircraft? So it will vary airline to airline, but there will be airlines who continue to make the A380 work as part of their networks.
Thanks, Steve. There's another question here around whether these times of crisis and the emerging recovery would be a great time for launching a new disrupting leisure or network carrier that could start off the ground with no debt and take advantage of the low leasing rates that you highlighted before, Steve. So is this a good time to start a new airline, I guess is the question.
Look, if ever there's a good time to start a new airline, it's a good time to start a new airline. Like, lease rates are low, you've got ready availability of pilots and staff and management teams, and we're actually working with several investors looking at starting new airlines now. So unfortunately for the established carriers, the answer is yes. Like, it is a good time to look at being a challenger and coming in with a reset, more competitive cost base than the current players. Now, there's a longer term question. Is it good to be in the airline industry anyway? Remember, the analysis shows over the long run, this industry has not returned cost of capital. So if you're persuaded that you do want to enter the airline industry, now is the right time. But I think we would say, look, you need to take the long-term view on this as well. Where do you see demand headed, and what does the future competitive environment look like?
All right, thank you. I think we've reached time, and so I'm afraid we're going to stop the Q&A session here. Thank you, everyone, for asking your questions, and apologies to those that we didn't get to. We tried our best. And if you can just go to the next page, yeah. For those of you that haven't seen or haven't read the article yet, there was the basis for this webinar. It's on our website, and you can find it there. There's also a number of additional webinars coming up that you might find interesting, from very generally how to get hybrid working right to more airline-specific topics. If you're interested to stay in touch, feel free to scan the QR code and sign up for our newsletter, or just send us an email at the email address that's shown below. And with that, thank you very much again for everyone for joining us today, and we wish you a good rest of the week and a good weekend.